What's up, guys? Welcome back to Everyday Money. If you're out there on the internet and looking through YouTube and what have you, and you look at any of the financial channels or real estate investing channels, almost every one of them has a video on there that says that real estate is going to crash in 2021, and there's just general doom and gloom, and everything's going to be bad because there was this virus, and there was a bit of a financial crisis during that, and people have been laid off work, and just general unrest in the financial systems. They've put out a lot of videos that says that housing and real estate is going to crash in 2021. And I just do not believe that that's the case, because I don't think that this is like 2008 where housing is going to crash. But I do think that there are a lot of folks that would like to see that happen. For one, it gets clicks. Let's face it. Anytime you're looking at something where you're saying the housing market's going to crash, it creates drama and it gets clicks. And they all have the reasons in there why they say that the housing market is going to crash, et cetera, et cetera. But bottom line, you're going to get clicks, you're going to get watch time with those types of videos. In addition, investors and home buyers would love to see the housing market crash. There's a lot of people that have been priced out of the current housing market, and I can understand their frustration and that they would like to see housing come down to a point that is affordable for them. On the flip side, investors, such as myself, would benefit. I'm not saying that I would like to see a housing market crash, but we would benefit from lower housing prices where we could get into rental buildings or flips or whatever for a much lower price than they are going for now. But again, I do not think that housing is going to crash in 2021. As a matter of fact, I think it will continue to soar in 2021, or at worst, move sideways or maybe just slightly up. And we're going to get into all that right now. So I want to get into what the differences there are between 2008 and what we have going on right now. The biggest one is that housing was the problem in 2008. Risky loans were given, home values were inflated way beyond what they should have been, but everyone had a job. And people were just taking on loans that were too big for them, and banks were lending out money that was too much for the borrower, and they knew that they couldn't afford to make those payments, and they did it anyway. A lot of times to get the fees and origination fees and things of that nature that the banks and the mortgage brokers would get, without really considering, the ability for the borrower to repay that. So the system housing market was the problem. In this case, there is a virus that is causing the problem. And the biggest difference between these two is that for this particular crisis, there has been massive government support for individuals, for citizens, for homeowners, just around the country. Remember in 2008, we basically said, well, we'll give trillions of dollars to the banks, and they can loan that money out. And what else will we do? You may be able to get a loan modification, maybe. And that was about all that they did for the homeowner. And a lot of folks went under and they were foreclosed, and the foreclosures killed the value of the rest of the market. However, in this time, the government basically caused the problem. Now, I'm not saying that they caused the virus, but the shutdowns put people out of work, especially people in hospitality, restaurants, travel, things like that, where folks are going to be around each other all the time. Those folks have been decimated by this coronavirus pandemic. But what the government did do is they gave us the ability to put mortgages on forbearance up to 1 year in 2 6-month chunks. They added extra unemployment onto state unemployment benefits that you would normally get. They gave us direct stimulus checks twice now. And for the average family of 4, they have gotten $5,800 out of the 2 stimulus programs. And people might say, well, that's not enough to get by on. But that's way more than the government gave to you during the 2008 housing crisis. They had the Paycheck Protection Program that tried to keep people employed by giving companies forgivable loans to keep people on their payroll. And then the home values have been going up, and they are up. And it has allowed people that if they did get into trouble and they looked like they were going to be foreclosed on, to pretty much easily sell their home if necessary. Now, that's not a great situation, but it was a heck of a lot better than in 2008 when home values were really underwater and there was no way to get out of your home without owing money on it. So the no foreclosures to drive down the rest of the market has really been a helping factor in keeping people afloat during this financial crisis, during this virus crisis. And another one of the big differences is that lending standards are much different in the lead up to the crisis of 2008, where they were just, again, giving homes to people that definitely could not repay, that had shoddy credit, and it was just bad banking and bad lending. Lending standards since then have been so tight that it is hard and a time-consuming process for even someone that can easily make the payments and has excellent credit to get that loan. And all those things have made these prices, these values, and this increase in housing prices much more sustainable than it was between the years of like 2000 and 2008 when the home market ran up and then crashed. So these are the reasons why I think housing will just continue to soar through 2021. And it's inventory, low interest rates, huge demand, and people having money. And I'm going to break down these four things. First off, inventory is at record lows. In September of 2020, we got down to a 2.7 month supply of homes on the market. And there was talk on news channels and real estate and financial magazines that we may run out of houses for people to buy. Now, that never happened. It did creep up a little bit, but we got down to a record low amount of housing inventory for a record high demand. And obviously when, simple supply and demand is really high, inventory is really low, makes the prices really high. That's just simple supply and demand. The only problem is this isn't like ramping up production on widgets, that you can just turn them out really quick. We're building actual houses, and home builders have been trying to churn out houses, but they just cannot keep up with the demand for new housing units, especially single family housing units in a reasonable price range, let's say from like 150 to 300, because the ones under 150 just really don't have a whole lot of profit margin to them, and then the ones over 300 in some markets are not affordable for the people that are looking. In addition, what is really raising new home prices and also keeping more inventory off the market is that raw building materials for building these homes has just skyrocketed as well. This coronavirus thing with shutdowns has shut down mills and factories and all the other things that need to run in order to produce building materials for new homes to be built to increase the supply of homes on the market. For example, lumber, just your typical 2x4x8, which probably makes up 85% of the structure of new homes. Maybe not that much, but it's quite a bit. Has gone up from about $3-ish, maybe a little under $3 per board to $6 or $7 per board. And obviously that's at your like local Home Depot, Lowe's, whatever. Builders may be able to get it a little bit cheaper, but I have read reports where a similar lumber package for a building that they were building in 2019 costs almost double what it does it costs almost double in 2020. So that's going to add on to the price of homes, and that's going to also slow the amount of building that can happen, because again, there's also a limited supply of this material with all of these shutdowns as well. In addition to low supply, high demand are very low interest rates, like off the screen down here where you can't see it. Way down. Historically low interest rates. And for you guys out there that are homeowners right now, if you haven't refinanced and you're somewhere in the 3s or 4s on your interest rate and you can refinance, do it now, because we're talking about 30-year mortgages between 2.5% and like 2.875%. Super low rates, which is also the amount of effort you have to do to smash the like button for me and help this video out in the YouTube algorithm. It's my little Graham Stephan thing going on here. So the super low rates are going to increase the buying power of anyone. Your money goes further when you're not paying as much in interest. So naturally then people could afford more expensive or larger or nicer homes for the same amount of money per month as they were when they had higher interest rates, such as 4, 5, 6%, or going back to the 70s, 15, 16, 17% interest, which was the norm. The flip side to that is that anytime easy money is involved in something, it tends to raise the prices. And that is exactly what is happening right now, is that people can afford more, so buyers ask more. People aren't stupid. They know that when that happens, that they can ask more money and that the interest rates will allow people to still buy their homes. Rates are low because the Fed rate is at essentially 0%, and that is to provide easy credit for businesses and people to do business and buy things and stimulate the economy, because we are a consumer capitalist economy, and people need to purchase stuff in order for that machine to keep spinning. Rising rates would cool the market, but I don't expect that to happen anytime soon, as the government continues to try to stimulate the economy and to keep government debt payments low. You see, because the government right now has more federal debt than it's ever had in its entire history. And if those rates were to go up, and there are a lot of other things that are related to the interest that the government pays on its debt, but raising rates would increase the rate that the government pays on its debt. If those payments go up, they could become unaffordable to the government, and then they would either have to raise taxes or cut programs and services, which I'm sure if you guys have watched anything about a politician, they probably won't say anything about raising taxes or cutting services to their constituents, or they probably won't be a politician in that district much longer. So it behooves them to keep the rates low in order to keep the debt payments on the federal debt low. And so I think that rates are going to stay low for a long time because we have a lot of debt, and we're talking about putting on even more debt with things such as student loan bailouts, another stimulus program, and all sorts of other government spending that has been proposed by the new Biden administration. And then my final reason why I think that housing is going to continue to soar in 2021 is that people have money. I mean, that is the thing right now. I know that there were a lot of folks that were hit very hard by the coronavirus pandemic, and like the ones that I mentioned earlier, hospitality, restaurants, airlines, travel type of folks. Those folks have gotten decimated, and I feel for you guys. But there's a lot of folks out there that are doing just fine. They're doing as good as they were before, and in a lot of cases I hear people say, I've never done better, and their expenses are lower because they're not commuting, and they're still getting stimulus checks because they're sending them out to everyone. And that reflects in the real estate market. The cash sales are still very strong. And a lot of those are investor sales. A lot of times investors will use cash purchases in order to snatch up real estate really quick. But overall, cash sales for real estate are very strong. The stock market is very strong. It did not crash significantly for a long time. So we did have, I think around April or so, there was like a 20% dip in the stock market. It looked like it was going to crash. But it had fully recovered and now is at record highs. I mean, it fully recovered within like a month or 6 weeks or something like that. It was a very short period of time. And now, sitting at the beginning of 2021, we are at record highs. The S&P is over 3,800 the last time I looked. And this is different from 2008 when everyone lost their jobs. Everyone lost their houses. The market crashed by like 50% and stayed there. And it took a long time, years for it to get back to where it was. People have that money. That money's available to them. A lot of folks have a lot of stocks. Unemployment is not nearly as bad long term as it was in 2008. Right now, the last time I looked it up, unemployment was sitting at 6.7%.
Not great, not terrible.
Now, it did get up to like 14.7 at the beginning of this pandemic thing when we did all of these shutdowns, which was higher than it was in 2008. But then again, all of those programs that I talked about earlier in the video were instituted immediately, whereas we didn't have anything like that for the most part in 2008. So even though folks were unemployed, initially the unemployment is down to 6.7%, which isn't too terribly bad, considering all the things that we went through in 2020. And then, like I said, I know that a lot of folks out there are still hurting, especially in the hospitality, travel, airlines, and things like that. But overall, people have money. Not only that, credit is still in good shape. People have not lost their homes. They don't have foreclosures on their records. They're not using their credit cards to cover expenses. Again, for the most part, I know that there's a segment out there that is exactly what I described. But between the low supply, the low supply, the high inventory, between the low supply, the high demand, interest rates being low, and people having good money and good credit, I don't see any stopping this real estate missile that is going up right now in 2021. Not saying to say it's going to go on forever. It can't go at this rate forever before there's some sort of a breaking point. But in 2021, I see real estate continuing to accelerate, and if it doesn't accelerate, we just find the price ceiling where people are just unwilling to pay that anymore, then I believe it will just sit there and go sideways until we get to a point where either there is some sort of major financial thing that just drops the bottom out of it, or people are just making enough money that it just continues to go up in price. So that is my 2 cents on the housing market. I think that is the way that we are going to go in 2021 unless one of those 4 factors changes in a major way, which I also don't see happening. I think things are going to just keep on going up and up and up for now until we hit some sort of a price ceiling or something where people just aren't willing to pay those prices, or we get some other major financial catastrophe, or if things go well, it just continues to go up maybe at a more normal pace in 2022, 23, 24. Be sure to smash the like button for me if you like this, you got some value out of it. That really helps out this video in the YouTube algorithm. Be sure to subscribe if this is your first time here. I appreciate you guys watching today, and I will see you next time.